Financial markets often give clues to the pace of economic recovery before we see it in the data. But in today's landscape, many financial assets are being driven by policy intervention, rendering their signaling value less useful. Therefore, we've mapped out 3 potential scenarios and how key global markets might behave in each case. In our optimistic scenario, we believe emerging market assets would outperform as the US dollar depreciation takes effect. In this case, we predict the dollar's deteriorating fundamentals would take on greater importance as risk sentiment improves. The Indonesian rupiah and the Indian rupee should continue to recover, and we would also expect the year's underperformers to catch up, including the Thai baht and the Russian ruble. In our central scenario, we predict recessions would hit the US and Euro area in 2020, while China would see its slowest pace of growth in several decades. The US dollar would lose fundamental support, but would be supported by risk aversion. In this case, we prefer to focus on the haves and the have-nots in foreign currencies. We like the Indonesian rupiah and the Indian rupee, but we would also like to hold the Japanese yen and gold for protection. In a pessimistic scenario, caused by a second wave of infections or increasing geopolitical tensions, renewed risk aversion could raise the question of which safe havens to hold. In this case, we believe U.S. Treasuries would offer less value as a hedge. Gold would be attractive as developed market real yields slide further into negative territory. While we forecast the US dollar would stay strong amid increased risk aversion, the Japanese yen would ultimately be our preferred currency.